In this video, I'm going to explain why stocks fluctuate and answer the question how they continuously change every second. For this demonstration, I'm going to be using the information taught in my previous video where the price of a stock comes from. In that video, it explains the price of a stock is calculated by the market cap divided by the outstanding shares. Further on in the video, I'm going to explain how this creates a stock's value to go up and down every second. Now there are four main factors when looking into changes in a stock's price. These factors account for both the short-term and long-term. These four factors are due to the government, international trades, speculation, and the main factor I will most importantly talk about is supply and demand. Supply and demand is the foundation of the stock market and is related to all other factors. First off, government. Government can increase and decrease tax rates and interest rates. Interest rates are the amount lenders charge on top of the amount they let you borrow. Tax rates bring more or less money into the economy by lowering or raising your tax bill at the end of the year. Stimulus packages put more money into the economy, which allowed for more investors to purchase shares. By doing this, the government can alter how much money is in the market. Second, international trades. If our country pays other countries for something, then money is leaving the country. Compared to receiving money for U.S. goods, when money leaves, that weakens our economy. Money for U.S. goods brings cash to the market to reinvest and grow higher. The third is speculation. A very popular example is the dot-com bubble from 1995 to 2001, where everyone thought these new technology companies were making a lot of money, but did not realize the cash flows behind the business were mostly very poor. Now all these factors relate to supply and demand. In order to know why this affects a stock's price, you need to understand the variables applied. The equation to calculate a stock's price is market cap over the outstanding shares. The stock price and market cap directly relate with each other as variable costs, where if a stock goes up 5%, then the market cap does as well. Now this is very important to understand that the outstanding shares is a fixed cost and does not change unless a company issues more stock to banks and businesses or sells them in order to have more cash. Typically, a company sells shares to raise cash because they are going debt and need cash, or because a company needs the cash to improve their business early on. Generally speaking, a very successful business should not have to sell shares because they improve their business using their own profits instead. Now how does this relate to supply and demand? With outstanding shares being a fixed number, the higher demand for a stock will increase its price. For example, if a stock contains 1,000 shares and is worth $10, this means the market cap would be $10,000. And if investors believe this company is worth more than $10,000 based off of potential growth, then the greater demand for the stock will raise its price because there is not an infinite number of shares. Based off of the interest a company gives to an investor to purchase shares, this is what determines whether a stock bought today may be worth much more or less a year later. This is why the fixed number of outstanding shares is what creates supply and demand in the stock market, and therefore explains the ups and downs of a company's value. Thank you guys for watching. Please leave a like and subscribe for more.